The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, June 9th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're very glad you are with us tonight. And of course, here we are in this bear market, or so it seems like it's never going to end, but I am seeing signs of ebbing inflation, and I'm actually going to call a bear market bottom here tonight. I may regret this. I'm not saying it's today or tomorrow, but I think it's sooner than later. Let's look at the data and see if you can corroborate that. If you're new to the program, we cover a variety of topics on a monthly basis. People chime in from time to time, ask questions. I answer them in real time. If you have something you want to ask that we don't get to during the program, or you just don't feel comfortable asking during the program, just shoot me an email, cb3@cb3.com, and I'll handle it one-on-one. So if you're new to the program, please be sure to subscribe to us on YouTube. Click the little bell so that you get updated when we go live or when I upload one of my intra-monthly updates. We're also on Twitter and Facebook and LinkedIn. I tweet every single day, sometimes twice a day. You can follow my thoughts there and respond. We have dialogue from time to time from people there on the social media channels. So the monthly market review, let's face it, since January 4th, we have headed down. We opened on January 3rd. We had one day up, and the rest of the time it's been down. And it wears on you. I understand that. But what I'm going to do tonight, I have about 30% less slides than I normally have because I'm going to slow down. I'm going to ask you questions. You can type your answers in the chat. I'm going to spend more time on the slides. My goal, as is always the case, but especially tonight, and especially with the market move today with the ECB's Christine Lagarde saying, oh yeah, we're going to start tightening and raising interest rates in Europe too, which was not a good way to get started here, in the western part of the world when we heard that. So I want to walk through this very methodically. And if you have questions, please ask them. This is from Genesis, not the book Genesis, but the band Genesis, Tony Banks, the writer. For nobody will understand, but we must understand. You fear what you don't understand, and you kill what you fear. That's an album from about 50 years ago, one of my favorites, but it's true. It is not useful to be fearful in the markets. And in fact, if you're fearful, that's a time not to be making any changes, because we don't make good changes emotionally when we're in a bad place. Let's look at the charts. This is the S&P 500 from 1948. I think all of you can agree that this is an up chart, okay? You see the blue arrow on the bottom there? That's the spike of the 2020 recession. In case you've forgotten, that's 2 years and 3 months ago when the pandemic began. That tiny little dip there. Remember how awful it felt when our accounts dropped 33%. And in this current recession or current pullback, recession is kind of an if, all right? But the bear market is pretty obvious. We haven't been anywhere close to that 33%. It's just persisted longer. And that's the first important point I want to make to you. It's the length of time that's making this one so uncomfortable. So this move that you see in green up to the point where the top arrow is, and that tiny little bit to the right of the arrow is the downturn in which we are right now. But look back to 1948. You can see that it's just a tiny, tiny pullback in consideration of the last 80 years of market history, okay? Note that the U.S. stock market has never moved so quickly to the upside. Never. I'm going to go back to this slide. And yes, you see these up moves, but look at the parabolic behavior of this movement out of the March 23rd 2020 low in the previous bear market, when people realized this is crazy. We're throwing away these great stocks. And what's really in play here is a healthcare scare. This is not a financial scare. This is not 2008. Okay, not 2001. This is a healthcare scare. I'm not minimizing that. I'm just saying that in the market's view, it was way overdone. So the market shot up to the upside and overheated. We have never moved this quickly to the upside. We had simply run way too far. Now, the 2020 pandemic introduced a whole new set of investors and traders to the stock market. Many of them, and many of them are younger traders, are scared right now because they've never seen, these are 20-somethings, have never seen a 5-month bear market. The only one we had, or they have, for reference, is 2 years ago, and that was the shortest bear market on record. So I want to zoom in now to just the last 12 years to the far left of the chart. That's the downturn. This is the S&P 500, and those bars, when they're red, they're going down. When they're green, they're going up. Okay, that's the 2008, 2009 huge sell-off. 51% at the low. March 9, 2009 was the low, 676.53 in the S&P 500. I know that's a crazy number considering it's about 4,000 today, but that's what happened. Now note that with rare exception, the market prices stay above the green line. That's what we call the 20-month moving average. It's not really that important, but note that most of the time it's going up. Where do you see the exception? You see an exception in 2018 when it dips below that. You see an exception in 2020, but then it recovers and continues. That is because we are in a secular bull market. So what happened in these little downturns? Those were cyclical bear markets. They were shorter. What's the preponderance direction on this chart? Folks, it's up, just like the previous chart of 80 years that I showed you. We are in a downturn right now that's highlighted in blue or purple. All right. We're resting on that green line. It is possible we could trade a little bit lower. Now, today was a little bit of a shocker, mainly because of what the ECB came out. And again, we're a world economy. We're interrelated. And it spooked American investors. And of course, we have a huge number coming out tomorrow. The CPI, Consumer Price Index, the second reading. If that continues to drop, the market, I think, is going to go significantly higher because it wants to end the week higher. If it's a shocker and it has reversed, CPI has reversed to the upside, it's going to be another difficult day like today. I'll be watching that, I assure you. Nonetheless, you can see from the chart here, just soak it in. I said I'm going to stay on these charts longer tonight. We are not down in serious dip territory like we were in 2020, where we went well below the blue line. The bottom blue line there, the thicker blue line, is the 50-month moving average, okay? We haven't even come close to that. The reason, again, that this feels more difficult and nagging is because of the length. If we had gone down January 4th, which was the high, and we were back on track by mid-March, nobody would be complaining. It's that here we are on June 9th, and we're still in this morass. Now, look at this chart. How much of the S&P has dropped during the past bear markets, okay? So look at these percentages. I want to ask any of you that are live and want to respond to this. As of January 1st to today, what do you think the drawdown is in the S&P 500? You don't have to get it to, within 0.1%, but type it in the chat. If you think it's minus 5%, and then do an equal sign, okay? SPX, that way we'll know it's the S&P. Because I'm going to ask you about the NASDAQ too. So this is an interactive program tonight. And because of the 25-second delay, I need to be patient and give you guys a chance. So you can see these downturns. Okay, September 01, 02, 08, 09, 20. So what do you think the S&P is down as of today? All the way back from January 1st, okay? Do you think it's better or worse than these numbers? And if you want to type in what you think it feels like, that's fine. But I'll give you the actual data, okay? Well, I think I've talked on long enough here, so either you guys are not responding or it's still on a delay. So I will give you the answer. The S&P 500 is down 15.7% year to date. Okay? Nowhere near these drawdowns. Okay? The NASDAQ is down much more than that, 24%. Okay? But even that is less than all four of these previous bear markets. So what has made this one different than the previous one? 10% maybe. Okay. That's a good guess. So I guess the delay must really be long. That's good, Dr. J. So 15% on the NASDAQ, 15% on the S&P 500, about 24% on the NASDAQ. All right. So what I'm saying is that the market behavior you're seeing is not unusual. This is typical market behavior, and it's not even as bad as we've lived through in the past. Those of you that have been clients, and some of you on this, or that will be watching this at some point, have been clients all the way back to 2006 and lived through that 2009, 2010 period. This is nothing so far compared to that, and I don't think we're going to hit anything near that 2008 number. I just don't see it. That would take us below the 2020 low. I don't see it at all. So what I'm trying to train you to have, and I got this phrase from one of our viewers who is a CME or was a CME, Chicago Mercantile Exchange floor trader, diamond hands. What does diamond hands mean? It means that someone that has diamond hands has a high risk for tolerance or can stomach pressure, okay? Diamond hands is a slang term for an investor who refrains from selling on an investment despite downturns or losses. That seems sensible. Why? Novice investors are not having diamond hands, so they sell. Now, what is happening in a bear market, we'll get a lot more into this when we have more charts here to show you, is that weak hands are selling into strong hands. And strong, well-capitalized hands, okay? They are the ones that have the diamond hands. But now you guys are going to be aware of this, and I hope that mentally, when you look in your account and see it's down again, say, you know what, it's fine. I've got diamond hands. Now, I want to be really careful to say this doesn't mean that if you have a stock portfolio of 33 stocks, which is what I have in CG, 33 stocks, at 3% weighting is 99% allocated and 1% in cash. That doesn't mean we don't rotate out of really underperforming stocks, but in a secular bull market, it does mean we stay fully invested. Based on the charts that I showed you earlier, remember, you really have to lean in to see the downturn we're in compared to an 80-year market performance, okay? You guys with me? All right. Okay, so you guys have seen this chart many times. All right, the red squares are bear markets, and I want to point out that even in secular bear markets, and there have only been 3 in the last 100 years, the market still has a return. It's just not very much, okay? The one from the 20s, now notice the little red circles in the bottom. I'm going to take time on this. I haven't done this in previous because I usually have so many slides. These are technical indicators, and I understand this is what those of you that are clients, you pay me to read this and interpret this, but I just want to show you what we're looking at here, okay? And again, we don't make decisions on a day-to-day basis. We make decisions usually on weekly or monthly data, and then we act on them, okay, on a daily basis, if necessary. But we're using the data to inform us from monthly charts or weekly charts, much of the time from monthly charts. So what you're seeing on all the red little circles that are at the bottom are times of extreme negative sentiment. And what has to happen when we're in a secular bear market is those numbers are hit way down there at the bottom when everyone is just absolutely desperate. They never want to see another stock. They hate it. And that kind of sentiment, that super extreme sentiment, happened during the Great Depression. It happened during the 50s. It happened between 2000 and 2009, that low that I mentioned earlier, okay? But in between then, you see the blue lines, and those are 20 to 22 year, 3 of them, and we're in the middle of one now, secular bull markets. There are downturns in there. And if you look again carefully, you see the little cross there at the top. Look straight down from that a little bit to the right, and you'll see that little itty bitty little downturn. That's the 2020 pullback for the pandemic. And again, this gets back to this word that I know I overuse. Forgive me, guys, words I should say. Recency bias. It feels like what we're going through right now emotionally is the worst it's ever been, and it's just not true. This is the history of the market, and I've been doing this since about 89, 90, and so I've seen this kind of downturn, the end of the last secular bull, that entire 10-year secular bear market, and somehow we did get through that, and now moving into this secular bull market. Okay, look again, this is the same chart, except look at the very top. You have to lean in to see it, okay? The little yellow dot is the beginning of 2022. So we're now 5 1/3 months into it. All right, that little yellow spot, again, lean in if you can't see it. That's what we're doing right now. That's it. I know it feels worse than that, guys, but that's what we're going through right now. The data underneath that are the individual sectors. There are 11 of them, and you can see the returns since April 10th, 2013. I know you can't read all of that because it's so small, but believe me, they're all very positive. I'll give you one. The NASDAQ is up 375% since April 10th, 2013. Now, it has had downturns, and it's probably going to have more before this secular bull runs out. But I am calling it in the past, and I'll do it again tonight. I think that this secular bull market, with interruptions for cyclical bear markets, this secular bull will run through 2032 or 2033. Okay? That's 10 to 11 more years. For most of us, that's a pretty good run. And so, I don't know how else to show you guys this. It's here. This is actual history. This is an opinion. This is data. So now, to give you plenty of time to answer, I'm going to talk about these bear markets, but I want you to type in the chat box what percent. All you have to do is put a percent number. What percent of these bear markets did we exit? Okay, that might seem rhetorical, but how many of these bear markets did we actually exit? All right, it's kind of a trick question, but I think if you think about it, you're going to be fine. So type that in, whoever wants to answer. So obviously 1903, the rich man's panic, that's the gold rush and everything, panic of 1907, the Trust Act, World War I. Look at these downturns, 51%, okay, post-world bubble bust, 1929 crash, 86%. All right, these are huge economic, socio-economic events happening. This is not what's happening right now. Okay, 60% downturn, the Great Recession during World War II, leading into World War II. The post-bear market, all of them. Good answer, Charles. 100%. Dr. J, thank you both. 100% of these bear markets we exited, okay? Black Monday, the dot-com bust, 56% down for the global financial crisis. 100% of these we have exited. It didn't feel like it at the time. I'm sure there were thousands, maybe hundreds of thousands of people during each one of these saying, it's never going to get better. It can't possibly ever come back. The market is going to collapse and we'll never have our money back. That is what the diamond hands want you to think. And after this program, I'm hopeful that you're going to adopt that mindset. You've seen the long-term 100-year charts of the market. All right, you need to adapt that mindset. That doesn't mean that you don't rotate, that I, as your money manager, don't rotate into different stocks. And it doesn't mean that if you're in a too risky a program now, and when we pull out of this in December or January, my target date for new lifetime highs is the middle of January. Okay, we could spend the summer just wallowing here. I mean, that's what it's looking like right now. A lot of it depends on how this inflation situation is handled. Okay, but I'm thinking we're seeing new lifetime highs in January. If that is the case and it's been really difficult for you emotionally and you're a client, we need to talk. You need to be in a less aggressive program. If you're not a client, talk to your money manager and say, you know what, that was a pretty interesting ride, like a roller coaster. You get off the roller coaster and go, that was okay, but I'm never doing that again. Okay. Then go on the merry-go-round on the little horses that go up and down. It's still fun, okay, but it's a lot less volatile. All right, so top 10 S&P sell-offs after 5 months. So these are now bear markets that have lasted more than 5 months. A lot of times a cyclical bear market only lasts 2 to 3 to 4 months. Guys, this was a long one. All right, so far it has definitely been a long one, but look at these downturns. And I've already told you the S&P right now down 15%, NASDAQ 24%. We certainly have had worse ones. There's actually a little bit of a juxtaposition here between the S&P and NASDAQ. Normally, it's not that different, but I think what happened was, and those of you that are in CG that know we made 62%, 63% in SG in 2020, those growth stocks just got overvalued. And so they're coming back down to earth, but they will go back again once the fear is out of the system. If the market is at all-time highs and it dips from there, it's because there are no more buyers. And it goes back up when there are no more sellers. And as you well know, if you've ever ridden a really wild roller coaster, you go up just as high from the ground. It's just not very scary. But when you come down, it's definitely more scary. The stock market works the same way. There are 3 phases to a bear market. Now notice there's not any real time constraints on here, although they've tried to estimate it with the number of days because they've tied it into previous bear markets, but nobody knows this particular bear market. It doesn't announce up front, yeah, just so you know, folks, I'm, Mr. Bear of 2022, and I'm going to be 178 days. So just kind of get used to that. It would be great. Where I think we are right now is either at the, let's look at the chart. Remember, we're slowing down here, guys. So the beginning of phase 3. So look at that purple line that's right about 1400. And again, just look at the shape of the lines. Don't worry about the numbers. All right, we're either at a downturn that's going to cycle back down, or we are at right underneath the word phase 3, and we're going to make another dip here without taking out the low from May 25th. Okay? Again, a lot of it depends on if we can get sentiment scared enough. And again, we need people that are going to be scared. We just don't want you to be in that scared group because the weak hands have to sell. And when they do, the strong hands come in and the market has one of these 10% up days that you can't miss. We've talked about this on previous shows. I'm going to show you again tonight why you can't. So this is the Fear Greed Index. I happened to grab the one for the crypto market. I made a mistake on this, but they have the same thing for stocks. And the one for stocks is actually at a 9. I checked it later once I'd already put this in here. So you tell me, where is there more potential for the market to move? How much lower can we go and how much upside do we have? Clearly, there is more upside potential than downside potential, but you have to get the last sellers out of the market. Because the deep pockets, the diamond hands, want to buy when they think there are no other big sellers coming in. So if you've got a big buyer that's saying, I'm just licking my chops ready to go in here, but I think Morgan Stanley's got another 6 billion shares they're going to share. They're going to be the one that takes this meter down to 3 from a 10. And obviously I'm just making up names here. They're not going to jump in the market. It's only when the biggest players say, okay, that's it. There's no one left to sell. And then they literally are backing up the truck and just piling stocks in on margin, whatever they have to do. And that's when you have one of these enormous 8 to 9 to 10% days. And you can't miss that, or you could miss literally a year's worth of returns. I'll show you that chart again. So I want to go back to this. I'm talking about more potential to the upside than the downside, okay? This chart is one, again, tons of numbers. Don't worry about that. Just look at the 2 columns on the right-hand side. This is just looking mathematically at communication services. That's the top sector. There's a downside risk probability-wise of 7.8% further, but the upside potential is 8.09. Where do we get this data? This is from RRG, and they look at historical performance after so much drawdown in all these sectors. And you can see quite a few of these sectors, not all of them, have a much greater upside potential than downside potential. And that is because on this chart, the sellers are just about getting exhausted. I assure you, when every sector here has a blue circle on it, meaning there's more on the right side. Let's look at financial, 17.7% up chance versus 11.9 on the downside. When all of those are green, and it's not like it's going to announce it, it's going to be midday someday when someone puts a monstrous sell order in that spikes the market down. And we actually had one of those today. Okay, it happened around 2 p.m. All right, so that will happen, and at that point, there will be no more big sellers. I wish I could tell you when that was. I really do, but I can assure you that's when it is. And this is what it's going to look like, that brown line there at 113 days, and then it turns back up. The market can't go lower when there are no more sellers. You follow me? It simply cannot go lower. When the last seller has sold, and I mean big seller, you know, you and I with 100 and 200 lot trades are not moving the market. It's the big institutions that are. Okay? The probabilities of the stock market gaining over time in any given year, 74%. Okay? That's 3/4 of a chance, 3 out of 4. On a 3-year basis, 84%, 5-year basis, 83. If you're 50 years old and you just are concerned about this, there's a 100% chance that at age 65, your account's going to be higher, significantly higher than where it is now. You still have a 74% chance at a 1-year basis. So again, if you are looking to use the money that's in your account in 3 years, okay, that's still an 84% chance, but it could be not that you're allocated wrong, but that you have too much allocated in high risk. And when you see our performance, I'll explain this. But once we pull out of this, remember I predicted earlier, I think we're going to see new lifetime highs by mid-January. That would be a time to go, okay, that was a fun ride, not so much. Let's conservatize just a little bit. Again, depending on your situation, and that's something I can only answer for you on a one-on-one basis. I mentioned just a few minutes ago that market timing can be costly. So we do some market timing as far as rotation of stocks, but as long as we remain in a secular bull market, I will be 99% invested in all of my programs. So if you've been wondering if Charlie's going to go to cash, no, I'm not. Might I put some very conservative investments in as a placeholder for a time? I could. Okay. But that would have been sooner in this move rather than right now, because you see the fear indicator, right? There's only a little bit further it can go, but if you're there, it can hurt. But there's just only a little bit further that it can go before it springs back, and we need to be there. If you're fully invested, that's a 10% return from 1990 to 2021. Okay, you missed the best day, just one best day in 30 years, that drops to a 6.1 annualized return. Miss the 2 best days, you're at 3%. Miss the 3 best days and you're at break even. And guys, you miss the 20 best days, it's bad. Okay. As a money manager, I can't take that risk that I'm going to miss one of those days. Now you could say, well, okay, just miss all the bad days. Yeah, that's true. Wish I could do that, guys. I wish I could do that. So you see this chart every time just before I present our performance, annualized. And so the historical return of the S&P, not return, the earnings reports has been about 73% beating. We're at 77%. Now, 2 or 3 quarters ago, we were seeing numbers like 82, 83. All right, and this is essentially all of the S&P. There's only 5 stocks left to report. And then on July 1st, it starts all over again. I would love to see this a little bit stronger, but I like seeing technology at 84%. That's highlighted in green, and industrials at 90%. Okay, these are risk-on sectors. These are sectors where people invest when they think the market's going up, they think the economy's strong. So those are positive. I would like to have seen financials in there and communication services, but it didn't happen. So that's where we are on that. All right, I am going to take a little break here, get a cough drop and a little bit of water. Here's where we are performance-wise. I was interested to see that in this downturn, of course, we've given back a lot. If you see capital growth, strategic growth year-to-date in 1 year, we're negative, as is the NASDAQ. We're more than the NASDAQ because we were invested very aggressively. It was working. So we have toned down both capital growth and strategic growth. Strategic growth is now beating the S&P and actually beating capital growth. So our two aggressive growth programs sort of trade on and off. In green is growth and income. And if you have that program, and for many of you, it's an appropriate program, you're down 6% year to date. Now that may not feel good, but it sure feels better than 20 something or 12 or 22 on the NASDAQ. Okay. So that's why we have 4 different programs, because each of them has a different reward to risk percentage or ratio. And that's really a discussion we need to have. If this downturn, if this ride on the roller coaster has been more than you'd like, let's have a conversation, okay? Now's not the time to change it because, again, I believe we will be near a turn where we get back to lifetime highs. That's the time to get a little more conservative, not at market lows, because you'll miss the upturn, okay? Makes sense? Lowering your expectations. That's just something that you've got to do. I've shown this slide now for 5 months, okay? Let me get a drink. And what do I see over here? Hey, Debbie D, what's cooking? Glad you're on. And Debbie B from South Florida, my hometown. Cubic zirconium hands. I like that. Dr. J, you might be the only person that has that, okay? All right. I see Debbie answered. So you guys got the question right about how many recessions we pull out of. 100%. How many bear markets? 100%. It's just tough to feel that good about it when we're going through it. I get that, guys. But again, here's the secret. Lowered expectations. That doesn't mean we're giving up. We're just working harder and realize that it's just been a challenging year and it's not done. Okay. But I think it ends well. Fourth quarter is always the strong. I don't ever say always. Fourth quarter is traditionally and historically the strongest. All right. So world economy, this is going to be pretty short here because I wanted to spend the time on those charts so that you really understand them. Situation with Putin is he hasn't really encroached on any more territory. And of course, the human toll is just horrible. I hate this man. And this, we're starting to see GDP cuts. Okay, so this is how it affects our portfolios when you see different parts of the world losing GDP. And again, I'm not minimizing the human side of this, guys, but this is a financial program. So where we have risk as investors is if it affects gross domestic product of our country and many other countries, because resources are being diverted to Ukraine and because just grains and all kinds of imported items are just not happening. The natural gas flow, Putin shut off Denmark. I saw that just earlier this week, and now they've got to go find other sources. Candidly, we have the resources to give Europe all they need. We'll get into that in the political section. But the reality is that this war will pass. But that's what's going on there. Inflation, it's just not as bad here as it is in other places. I realize that near 10%. Here's the reality, and I know there's some of you that just don't like it when I say this, but when the previous president left office, go back and check the data. It was 1.4% inflation. We're 17 months into this administration, and we're almost at 10% in certain areas. I mean, it's crazy. 17 months. And we've, sevenfold increase in inflation. You can't blame Putin on that. You can't blame the border on that. It's just policy, okay? And it's going to have to change. This is these kind of price, right? I have not seen this, but this is what they're sending me from California, okay? It's bad. And one thing I'm seeing about inflation that I like is that used car prices are dropping. And some of this is because new cars are more available. I had to drive a state away. There were no cars. When I wanted to replace my current or previous car in Nashville, I had to drive down to Alabama to get a car. And the guy told me there, he said, oh yeah, we have people calling from California. They fly here and they drive it home. All right. But what we're seeing by used car prices coming down is because people have inventory for new cars. There's not as much demand for used cars. What does that do? It drives down the prices. When you drive down the prices, what happens? It cools inflation. Yay. Okay. We want to see inflation cooling, and we want to see it done naturally and not with government intervention if it's not absolutely necessary. So that's a great stat. Maybe it's not a great stat if you're a used car dealer, but for us as consumers and investors, that's a great stat. So much of this inflation stuff that you're hearing that we're never going to get out of this, it's the same mindset as those that are telling you we're going to be in this bear market forever. It's going to be dark and gloomy for the next 5 years. I love this quote by Mark Twain. I'm an old man and I've known a great many troubles, but most of them never happened. If you think back to the charts that I showed you up front with an itty bitty little place in the top that was in yellow, you remember that? That's where we are now. The doom and gloom that you're hearing on the corporate media, it's probably not going to happen. I mean, most probably not going to happen. And I have the data to prove it, and now you do too. Employment scenarios. So last Friday, the non-farms payroll, the survey was for 318,000, actual with 390,000 jobs. Okay, I can break this out into the various sectors of the economy, but the two concerns that people come to me with are we in a bear market? Are we in a recession? Are we going to get out of this bear market? How many do we get out of? 100%. And are we going to get out of this recession if we are in one? You cannot have a recession. Cannot. When we're increasing jobs. You can't. So if next month's chart, there's a survey for 340,000 jobs and it comes in at 103,000, then we roll our eyes and go, maybe we need to think about this, okay? Especially if 2 or 3 months like that happen. But you can look at the little bars there and see we're not seeing that, okay? The unemployment rate continues to drop. It actually leveled out last month. You can't have a recession when the unemployment rate has got a 3 handle. It's going to have a 5 or a 6 handle. Handle is the number on the left of the period. Sorry for that little traderism there, okay? All right, so we're just not in a recessionary environment. The unemployment rate, if you look at Morgan Stanley, the FOMC, Bloomberg, other consensus here, looking out into 2022 and 2023, I'm not seeing anything that's even at 4%. Okay, there's a 3.6 in there. Maybe at the end of 2023, we have an unemployment rate at 3.6. That's not going to cause a recession. It's not. All right, this is the data. Now, these are forecasts, of course. Morgan Stanley, FOMC, which is the Fed, and Bloomberg. Okay, pretty smart people there. So this is my last update on COVID. If you guys didn't see this last week, there's this great chart. If you want to follow what's going on, honestly, it's not an economic factor anymore, so it's not really going to be part of what I'm doing. I guess I may have to bring it back, but this is it. If you want, it's John Hopkins. They've got this incredible chart. If you can see the link down there, great. If you can't, let me know and I'll send it to you. Anything you ever wanted to know, basically the risk has left the U.S. It's moved to Asia, where some people think it started, but I digress. But this is my last update on COVID, okay? So politics, why is politics important? Because it leads to policy, and policy affects our portfolio, and our portfolio affects our personal life. The biggest story in the nation, it's what's going to rule the election on November 8th, is inflation. I mentioned it earlier, and it is the policies of this administration. I know that rubs some people the wrong way. I'm sorry, guys. If you disagree, write it in the chat. I'm live. You can say something right now. But 1.4% inflation, people like. They may have really, really disliked the person who achieved that with his policies, but they like the 1.4 inflation. 10%, not so much. Okay, you go into a grocery store and a pound of ground beef is, $11 if it's 95% or 97%. And various parts of the country, you're going to see a pretty high voter turnout. And this is an off-year election, obviously, in November, but we'll see. It's just hard to continue with this. What I'm seeing, and I put this guy in here, I don't know if you know who Saul Alinsky is here, but he is sort of a social revolutionary. He's from Chicago, and he died 50 years ago Sunday. And so there's been an interest in the social media channels and, again, the more traditional corporate media. Let's research this guy and, look at some of his ideas. Guys, he's awful. He's awful. His goal was to, 50 years ago, take down America. One of his favorite lines here is, ridicule is man's most potent weapon. So, what you're seeing in America right now, and this comes under the political section, and guys, it's just inevitable. I showed you the chart last time of Elon Musk saying, I'm moderate right, and my friends are moderate left, but 20 years later, he hasn't moved, but his friends are way, way over there to the left, so that it makes Elon Musk look like he's far right. Well, he's not. But what we have is a culture in this country right now, which is going to radically change this country if it's allowed to succeed. And of course, to do that, they've got to win at the voter box, at the elections. So his social state, this is how to create a social state in his opinion. Healthcare, take over healthcare, create poverty. And you just have to look in the streets of the biggest cities in the country now, and it's awful. Massive debt. Both parties are responsible for this. Trump ran up a ton of debt. We have a $30 trillion debt. It's an unfathomable amount that can never be repaid. There's just not enough money to repay it. And of course, the gun control, and then you have these shootings. It's just all of these social issues are creating massive acrimony amongst American citizens, and it's just very disturbing. I put this in here last time, and it is no less true today than it was when he said it. If we lose freedom here in America, there's no place to escape to. This is the last stand on earth. Great words by Ronald Reagan. We have to find a way to unite ourselves and find a way to govern that benefits everyone, gives everyone opportunity. There will never be equal outcomes, but it's this kind of stability that investment firms, big Wall Street investment firms, want to see. Markets don't like surprises. They don't like anxiety. They just like nice, smooth up days, little bitty down days, little bitty up days. When you see these volatile swings, it's because there's uncertainty and anxiety. Economic indicators, I thought this was really interesting. This is from Barron's. So in 2020, for an American to feel, this was a survey taken, like they were wealthy, they had to have 2.6 million in assets. Well, in 2021, just a year later, it dropped to 1.9. Okay. Needed for financial happiness, 1.7 million. That's different than being wealthy. 1.1 a year later. And just to be financially comfortable, 934,000 versus 624,000. So again, what you've heard in the corporate media is that the COVID pandemic benefited those because all their stocks, that they had went up, but the everyday working man, seriously took a financial hit. Well, that's not what the data from the Federal Reserve says, okay? The bottom 50% of Americans, generally households with net worth of $166,000 or less before the pandemic, now hold a bigger share of the nation's wealth than they've had for 20 years. Look at the chart. Okay, the top 1% have only, increased theirs by 30%. The next 9% by, 24%, whatever. But the biggest change of the bottom 50, and this is because they were the ones that got the payments from the government. They saved it. They were able to change jobs because the demand, as we all know, we've been talking about this for months now, the demand for workers is at a level that I have never seen in my lifetime. I have family members that had 3 active companies pursuing them. All right. And they took a job and actually had to renege on the job and 10 days later not report because they got a much better offer from 2 different companies. Now, you're seeing this at all income brackets in America. And it's a position where workers have more strength than they've ever had versus employers. And even though I am an employer, I like seeing this. I like the field leveling out here in America. Americans are still spending. Okay, so their real personal income expenditures. Look at this. The blue line is the trajectory from all the way back to 2015. You see the enormous drop during the COVID pandemic, and now we've exceeded that. We're spending more personal consumption items than we did at any time previous to COVID. Why is this important? Because 67% of our GDP in America is driven by consumer spending. The rest is government spending and corporate spending, but consumers are by far 2/3 of the spending. So they're back, and that's a great thing. Okay, they're using their credit. They stopped putting things on credit. It reached a low in January 2021, but just in March of this year, that's the most recent data that I have, it's exceeded where they were spending during COVID. That is also a consumer sentiment number that we like to see. So from Morgan Stanley, what's the percentage of a chance that we're going to be in a recession? Again, those are our two fears, and I'm using the term with a wink. Are we in a bear market? How long do we take to get out? Can we ever get out? I think I've answered all of those questions so far tonight. But what about a recession? Well, Morgan Stanley, pretty wise firm, pretty huge firm, thinks this year it's less than 10%, right at 10%. Next year, 20%. 24 drops down to 10%. No recession at all, 30%. I don't see it. Now, could we be in a mild recession right now? We were in a mild recession in 2020 during COVID, but it happened so fast, if you blinked, you really didn't feel it because, again, the market recovered. We'll see if that happens this time, all right? As far as the Fed goes, the probabilities of a rate hike, the Fed finally, they're slow to the game on this, but they have raised 50 basis points. They're going to raise it again in June. They're going to raise it again in July. But what happens in September? That's what everybody's focusing on now. Again, the market, especially looking at the Fed analysis here, looks out into the future. And right now, there's almost a 70% chance that the Fed is going to raise another 50 basis points. That could change if we see some numbers like that used car number that I showed you. What we want to see is prices pulling back. And yes, unfortunately, that means our homes too. I'll get to that in the last section, okay? All right. Stocks really tend to do just fine during the early periods of Fed hiking. So again, tons of numbers here, but just look at the green versus the red. Okay, these are various times that the first rate hike happened, 1946 all the way up to 2015 and now 2022, just last month. All right, most of the time it's green. So everybody gets all in a tizzy and, what are we going to do? The Fed's raising. Well, here's the actual data from Bloomberg and the Federal Reserve. The market pulls through it. It just doesn't feel like it at the time. Mostly green on the screen. That's what you care about. Housing is the highest dollar value consumer discretionary item. I just mentioned, you wouldn't know this if you've been watching my show for a long time, consumer spending, 67% of the U.S. economy. What's the biggest ticket item consumers spend money on? Their homes. What's that looking like? Home equity is a lifetime high, all the way back to 1940. It's never been greater. Okay, what percent of GDP? And this is their individual GDP, but we're at 130%. All you need to focus on is this green line. It dipped dramatically in 2011, 2012, and then it's just been on a strength since then. And that is because, as you know, if you've Zillowed your home, Zillow's become a verb now, that we've just been increasing in home value. And because of that, we have what we call tappable equity. Now, I'm not suggesting that you tap into the equity on your home. Let's say, very simple numbers, you bought a home for $100,000 and you put 5% down and you have a mortgage for $95,000. I'm sure you didn't do that, but it's just easy math. And now all of a sudden your home is worth $140,000. And 2 years later, in parts of the country, that's not unrealistic. It does mean that the bank would give you a HELOC, home equity line of credit, for at least a portion of that difference between $140,000, the assessed value, and your mortgage at $95,000. Now, I'm not suggesting that you tap into that and go have a $40,000 vacation, okay? But people feel better when they know they have a little bit of a fallback, a little bit of a cushion there. So that has been a huge benefit of this COVID aftermath. You're still seeing tons of homes under construction, some of them not even started, not nearly as many as completed, and that's because of the material shortage. So the builders are out there, and we see them here in Nashville. I think I told you that maybe it was a couple episodes ago, when I was downtown meeting a client, and I got out of my car and looked around and saw one of the huge cranes, and I just spun around. It's like, how many cranes can I see? There were 9 cranes in a 180-degree turn in downtown Nashville. And I was just in one spot. Okay, it really hasn't changed. Okay, and some of it's because the demand is huge. There's not enough supply and there's not enough raw materials. So again, when you see this kind of demand for the highest ticket item for discretionary spending, you can't have a recession if things stay the way they are now. You can't. Okay, mortgage payments. This is a little bit of a risk. Okay, so mortgage payments are at a 20-year high. Okay, what is that? $1,675, the average mortgage payment. Okay, that's a lifetime high, or at least a 20-year high. I'm sure it's lifetime too. Okay, so what that means is that affordability has deteriorated. That initially deteriorated. Let's get that word out. Initially, of course, that's not a big problem, but if it continues, then that will put the brakes on inflation. Frankly, I've gotten a really nice bump on the Zillow value of my home, which may or may not be accurate. And if it just stays flat for the rest of the year, I'm fine with that. I would like to see inflation cool. I'm willing to, quote, sacrifice on my home, and maybe you are too, okay, just to see the economy cool off. If the economy cools off, where people are still buying and spending, but they're just not paying up so much for what they want, then the Fed's going to go, maybe we don't need to do all these rate increases, and they could at least stop the increases or might even have a rate cut. It would not surprise me to see the Fed cut in the December meeting this year. I'm on tape as saying that. Well, I'm actually on digital, but saying that. I've been saying this, but I wanted to show you the chart. So this is from MRB and NBER. These are two daily shot, aggregates these people, but NRB Partners does this research. You see the high spikes here, these green lines. The gray in the background are recessions. You see where we are. You see how much the stress index would need to increase in housing, in the housing cycle, to tip towards being in inflation. If this chart doesn't say it all, guys, I don't know what does. We are not headed toward a recession as of this broadcast. And it won't change in the next broadcast. By September, it might. And I'll be there to tell you about it. But right now, everything is saying we're in good shape. Okay? Crypto Corner. This may be the last one of those too, because I got this saying from one of our viewers. Don't forget, you can't spell crypto without cry. It has been a tough year for those of us who are invested in crypto. And I honestly can't recommend to any of you, unless you have a super high risk tolerance, that you should be in it right now. If you want to talk to me about it and whether you should sell or expand or just hold, I'm happy to talk to you about it. But I'm not going to continue to do these updates here until I have reason to believe that this is an investable entity for you guys. Okay. So that's it. Looking over the chat box. I'm going to pause just for a little bit here, give you time for questions. But this is what we do on our show. If you're new to the program, we cover a variety of topics. Again, we're changing some of these. Well, I'm sure we'll have some more new topics as we head into the autumn through the summer. I do plan to continue my show through the summer here. I may miss one in August. I'm not sure. But I may miss one in October, actually, because I may be traveling, and we'll tell you more about that later on. But I always have my gear with me, so I could do an update without the video and just audio only. But we're always there watching out for you guys. I think you know that. Giving you a chance here to ask any questions. You've been kind of quiet. I think Dr. J gets the vote for the cubic zirconium hands there. That's probably better than diamond hands. But it's my hope that you guys will consider what I said there. Look at the data. Look at years and years of data that I've shown you tonight, and for the last 2.5 years I've been doing this, and say, you know what? I'm going to be a diamond hands investor. We're going to be fine here. And you'll sleep better tonight and thank me for it. Okay? Next CB3 Live, Thursday, July 14th. Tell your friends. We'd like to have more viewers, okay? Follow me on Twitter, Facebook, LinkedIn. We're there every day. And I put this out there last time. I'm going to do it again this time, okay? Rich people play the money game to win. Poor people play the money game to not lose. I do not play this game to not lose. I play it to win. That does mean taking risk, and it's appropriate risk. And I do that on behalf of my clients. And if you have questions on how that's managed, let me know. Okay, and I'll answer it. I always finish my show with this from 2 Timothy 1:7. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Really appreciate you guys being with us tonight. I know it's a tough time. That's why I do these shows. That's why I provide this information so you can go back and watch it again. Go back, send these clips to your friends and say, look, I'm seeing the actual data here. It doesn't look nearly as bad. And what is happening, although it's ugly and gut-wrenching, is typical market behavior. Okay? You guys just hang in there. You're going to be fine. I promise we are going to be fine. Appreciate your kind words. Hope you have a wonderful summer. It's getting to be really pretty here. We have 2 new calves on our farm back there. And just look out in the world, see God's great beauty and blessings. And we'll stay here and be watching things for you. I'm Charles Brown, Portfolio Manager at CB3 Financial, where we don't just manage your assets, we become one of them. Good evening, everyone.